Hey everyone, welcome to the fourth episode of our Contra investing series where we discuss companies that are fundamentally strong but have corrected a lot. In today's video, we'll discuss Newgen Software. If you're following this channel, we have covered Newgen Software multiple times in the past and has been a massive wealth creator for the shareholders. However, in 2025, its stock price has fallen more than 50% from its peak. As usual, we'll put Newgen in our 4-point Contra investing framework and identify if it is a contra opportunity or not. Alright, let's get started. So first question we ask is the business fundamentally strong? We evaluate it on 3 parameters: business model, management quality and balance sheet. Now before we talk about the business model, we need to understand the problem Newgen is trying to solve. So large organizations in banking, insurance and government sector have one big pain point. Their internal processes are slow, document heavy and still depend on humans pushing files from one desk to another. For instance, loan approval takes time, customer onboarding takes time, compliance check takes time, not because people are slow, but because systems are old and disconnected. This leads to inefficiency, errors and poor customer experience. So Newgen is trying to solve this problem by giving companies a digital engine called Newgen One, which helps them in digitizing documents so that every file, form, PDF becomes searchable and organized, then automate workflow so that approval and processes move automatically instead manually, and build app fast. So if bank wants a new process, say digital KYC, they can build it quickly without writing heavy code. So essentially, Newgen replaces slow manual system with a clean automated digital flow. As a result, a company that installs Newgen typically see faster approval, lower cost, fewer error, better compliance, and the system scales as the organization grow. On top of this, Newgen has added AI layer that sit on top of the workflow platform to make the process more intelligent and automated. AI automatically reads document, extract key data, checks authenticity, detects fraud, score risk, summarize content and route file to the right team. So the entire flow becomes smart, not just automated. For banks and insurers, this means faster onboarding, faster loan decision, faster claim with much higher accuracy. Now you might ask, what is the moat of Newgen Software? So its biggest strength is deep domain knowledge. Company has more than 20 years of domain experience in banking, insurance and government processes. These are extremely complex, rule-heavy workflow, not something that you can copy by making a fancy UI. Newgen's second moat is customer stickiness. Once Newgen goes inside an organization, it becomes the operational backbone. Dozens of workflow, millions of documents, integration with core banking, ERP, CRM, removing it becomes really impossible. So the relationship lasts a decade or more. Then its third moat is it offers a full stack platform right from document management to workflow automation to low code plus AI, all in one system. And large enterprises prefer one integrated platform rather than having 4 or 5 different vendors. One of the biggest validation of their work is it is consistently recognized as leading player in the domain by 2 most reputed analyst firms in IT sector, Forrester and Gartner. Next very important point to understand in Newgen business is its transition from on-premise model to SaaS-based model. In fact, that was one of the biggest trigger for re-rating in company's valuation. Historically, Newgen used to work on the traditional on-premise model that included one-time license, implementation fee, AMC and so on. AMC is annual maintenance cost. It was good revenue but very lumpy. Today, companies transitioning towards cloud and SaaS deployment, especially with Newgen One. This changes the entire character of the business because instead of selling a product once, they now earn every single month from the same customer for years. What makes it even better is the way revenue behaves. With every new workflow a client adds, with every department that's get onboarded, with every increase in transaction volume, the revenue automatically increases. This is the classic sign of a sticky enterprise SaaS platform. Customers don't just stay, they expand their usage over time. And since processes like loan origination, onboarding, compliance, claim handling, etc., they run every single day, the cash flow from these clients become predictable, recurring, and extremely high quality. Now this slide gives a nice breakup by each revenue stream, where annuity revenue stream contribution is 56%, Key verticals include banks and insurance with 85% share, and business is nicely distributed across geography, no dependence on a single country. US is only 21%. Next, if you look at the management quality, its chairman and MD is Mr. Diwakar Nigam. He co-founded Newgen back in 1992. He has more than 35 years of experience in the industry, and he is an alumnus of University of Allahabad, IIT Delhi and IIT Madras. Newgen executive team is also stable and mostly long tenured. CEO is Virinder Jeet and COO is Tarun Nandwani. Both have been with Newgen for decades. Overall, company's management looks solid. Also, promoters have skin in the game with more than 50% stake with slight dilution in last 12 quarters. Next, if we look at the balance sheet, so Newgen is virtually debt-free company. Return ratios are also excellent at about 20%. Cash conversion ratio is also good with consistent cash generation from operation. Company also commands a solid margin of about 25% that shows the business strength. Overall, the fundamentals of Newgen looks solid. Now let's look at the second criteria. If you look at Newgen share price, it has corrected around 52% from its all-time high early this year. The big question here is, what went wrong? So basically, there are two key reasons for share price correction. First is slowdown in growth. In the last 3 years, Newgen revenue and profits have compounded at 24% CAGR rate. However, in trailing 12 months, revenue growth has fallen to 11% and profit growth is 13%. Then second reason for sharp correction is the expensive valuation. Due to high growth coupled with strong bull run, Newgen valuation got re-rated and it touched a peak PE of 85 early this year. But when the earnings growth reduced and market sentiment turned bearish, Newgen got derated. Now the question is, why have the earnings fallen in last few quarters? So one of the biggest reason is slowdown and delay in large deal closures. By the way, this is not just Newgen problem. It is the single biggest problem with all IT and software companies today. Due to AI, customers are still evaluating questions like, should we deploy AI? Can we redesign our workflow using AI? Do we still need the same number of people? And when clients are unsure, the first thing they do is they delay big ticket decision. So large license deals, especially in India and the Middle East, got pushed out. This is where Newgen felt the pressure because license revenue is lumpy. If a few large deals don't close on time, the numbers look weak. But here is the important part. The subscription and cloud business is still growing at nearly 20%. That engine is intact. And once clients finish their AI evolution cycle, the deferred deal will come back into the pipeline. Now, if you look at the result at high level, you won't be able to get such insight. And I know that for a person who has a job or business, it's very difficult to track so much information. That's where I try to add value by closely tracking the quarter result of nearly 200 companies. I do a deep dive to really understand the problem and share the insight with my close community of serious investors who want to make informed investment decision. You can get more detail on my website or join button of this YouTube channel. So moving on, the slowdown is definitely real, but it is temporary, not structural. The underlying demand for workflow automation plus AI is actually getting stronger, not weaker. Management has always guided for 20% growth in the long term. In fact, in the last quarterly con call, there was this question on 20% growth and management clarified that we don't see any change in the long-term outlook. The big question is, when would the growth come back? For that, we need to track the results closely. Now let's look at the third criteria. So third criteria of Contra investing is the long-term demand story intact? And the answer is absolutely yes. In fact, the long-term story for Newgen is stronger today than it was 2-3 years ago. Think about what Newgen actually sell. They help large enterprise automate complex, document-heavy, rule-based processes. These are not nice-to-have projects. These are core workflows like onboarding, lending, compliance, claims, account opening, KYC, and so on. Now add AI on top of this. Suddenly, every enterprise wants to modernize faster. Bank want AI-led onboarding. Insurers want AI-led claim. Then government want AI-led document processing. Everyone wants to reduce manual work, improve accuracy, and bring down the turnaround time. So the direction of demand is 100% aligned with what Newgen already does. Even the temporary deal delays we discussed earlier are not because demand has collapsed. It is the opposite. Customers are rethinking how to deploy AI, not whether to deploy it. Once this evaluation cycle ends, the deals actually become larger, stickier, and multi-year in nature. Plus, the shift to subscription and cloud is a structural tailwind that makes the business more predictable, more recurring, and more stable. So yes, the long-term demand story is absolutely intact. If anything, AI has increased the importance of intelligent workflow platforms like Newgen. The short-term noise does not change the long-term trend. Now let's look at the final criteria. If you look at Newgen PE ratio, it has fallen significantly from highs of 85 to current levels of below 40. While this correction looks steep, the problem is Newgen valuations are still not cheap. If you look at 3-year time frame, its PE is slightly below the median PE. And if you look at 5-year duration, current PE is above the median PE of 30. Although the way Newgen has evolved in last few years into SaaS-based model, the earnings are more predictable and recurring. Plus, its business has strong stickiness, so company will command a premium valuation. I believe that a good PE range for accumulating Newgen would be between 30 to 35. Or in other words, if you are expecting 20% kind of growth over the long term, at PE of 30-35, it would translate to a PEG ratio of between 1.5 to 1.7, which is a decent valuation. So effectively, the current valuations of Newgen are still slightly above the fair range. Finally, if you look at the smart money flow, FIs were consistently increasing stake in the company till December 24. DIS stake was more or less the same, but net public holding was reducing. However, in last 3 quarters, FIs have reduced stake, public holding has increased, including the number of shareholders. So it looks like institutions are also waiting for earning growth recovery. It would be interesting to see when institutions start increasing stake in Newgen. Technically, Newgen share price is consistently trading below its 200 and 50-day moving average. So after evaluating Newgen across all 4 criteria, business fundamental looks solid, company has deep domain knowledge, sticky SaaS-like revenue, AI-led differentiation, and long-term customer relationship. The challenges are temporary, driven by deal delays and global hesitation around AI deployment, not because demand has weakened. The long-term story remains intact as every bank, insurer, and government department is moving from manual workflow to AI-led intelligent automation. The only catch is, while valuations have cooled off, they have not become cheap. It still trades above the fair valuation zone. Although valuation is always a debatable topic, today I don't see a lot of companies in India available at cheap valuation. But I believe for a 20% kind of growth projection for the long term for Newgen, a fair valuation would be in the range of 30-35 PE, where the risk reward become much more attractive. In case you already hold this company, this is not a kind of stock you would panic sell after a 50% correction, because the fall did not happen due to fraud or government issue or debt problem or a broken business model. The fall happened because growth slowed temporarily and valuations were too stretched. Now the key is to track when growth recover, when large deals start closing again, and when institution money return. Until then, Newgen stays firmly on the watch list, waiting for right price and right trigger. So this is it for this video. There are many more videos in Contra investing series pipeline, so stay tuned. And which company do you think have corrected a lot and qualify as Contra bet? Let me know in the comment. I'll see you next video. Till then, take care.